Have you ever thought, I want to go to the Virgin Islands and write it off as a business expense? Hey, when I leave, they'll just be called the islands, right? Well, you're not alone. A ton of online influencers are saying the same thing. Just make it a business trip and you can deduct it. But what does the actual tax law say? I'm John Mitchell, tax attorney, enrolled agent, and former IRS Appeals Officer. I've been doing this since 1990, and I run a tax law firm here in Houston. I started posting online because I got tired of seeing tax myths go viral while the real rules get ignored. So today, let's clear it up once and for all. How to legally deduct your travel and the traps that can cost you big. Step 1. You need a real business. Sounds obvious, right? But trust me, this one trips people up all the time. Having an LLC doesn't automatically mean you have a business. The IRS only sees your activity as a business if it's continuous, regular, and considerable, and done with the primary goal of making a profit. It's not about what you say, it's about what you do. Ask yourself, did you do real research before starting? Do you have experience in this field? Are you putting in consistent time and effort? When you lose money, do you adjust your plan or just keep losing? Are you doing it mostly for fun or personal enjoyment? If those questions make you wonder whether you really have a business, you probably don't. And no business travel deduction. Step 2. The trip must be ordinary, necessary, and primarily for business. Under IRC Section 162, travel must be ordinary, which means common in your line of work, necessary, so helpful and appropriate, and primarily for business. That last part, primarily for business, is where people mess up. You can't take a week-long family vacation, attend one quick meeting, and call it a business trip. You can't go to your friend's wedding, make a TikTok about your brand, and write it off. Courts look at 1. How much time you spent on business versus personal stuff. 2. How significant the business activity was. 3. How much sightseeing or family time was mixed in. Step 3. Keep airtight documentation. Business travel gets extra scrutiny because Congress knows it's easily abused. Under IRC Section 274D, you need records showing the amount spent, the place traveled, the business purpose, and the business relationship of anyone involved. And you need these records at the time of travel, not recreated later. If you don't have complete records, your deduction can be denied, even if the trip was legit. You can't rely on estimates or memory. Step 4. Be careful with family or companion travel. Under IRC Section 274M, your spouse or kids' travel is deductible only if they are a W-2 employee of the business. Their presence serves a bona fide, legitimate business purpose, and the expense would have been deductible if they paid it themselves. So no, putting your spouse on the board of directors isn't enough. If they're not doing real, necessary work, you can't deduct their flight or hotel. Step 5. International travel has stricter rules. You still have to meet all the above plus 2 extra hurdles. 1. IRC Section 274C. You must allocate travel costs between business and personal days unless the trip is very short, under 7 days, or at least 75% business. 2. IRC Section 274H. The foreign location must be necessary for the business purpose. If you could have done the same thing in Dallas, you can't write off the Virgin Islands. Sorry. There's a lot of bad info out there, but here you're getting real tax law, not influencer fiction. If you want more straight talk on how the IRS really works, subscribe and let's keep cutting through the noise together.